Hey, it's Drake Griggs with Obsidian Wisdom. Welcome to another Retirement Readiness Thursday. Today, we're going to focus on high income earners. We have Eric and Denise. They're both 55. They want to retire in 7 years. When you're a high income earner, the question is less about the money, it's more about how much we get to keep. And we normally have to look at it from a tax perspective. Normally, if we're able to save a decent percentage of our salary and we don't have a significant change in our retirement lifestyle, oftentimes the question becomes, how efficiently can I build my retirement plan? And so, what I will do is I will share with you today their case study, and we'll go through some of the changes that we would normally look for when talking about high income earners, because your goal is to keep as much of your money as possible when you're going into retirement. We do not want Uncle Sam keeping too much of it. And I actually did a workshop last weekend, and someone we was an estate planning one, and the question was, well, Dre, if I've been paying taxes on this money my whole life, why is there a death tax if I make over a certain amount? And obviously, we're sitting here talking about the government. I was like, the government, whether we recognize it or not, they tax our income multiple times all throughout our life, right? If you have income from a salary, that has already been taxed once. And then if you invest that in the stock market, when you take that out of the stock market, even though it's taxed at capital gains, it is taxed again. And then when you go make purchases at a gas station, that's a gas tax. The grocery store, there's a sales tax. You have property taxes, even though you bought the house with money that was already taxed. And basically, what I said is our money is taxed multiple times, where it ends up being the numbers is roughly about a third to half of our money will be taxed. And we don't necessarily recognize all the ways that we are taxed, but roughly speaking, that's how it normally aggregates. Where at least a third of the money you'll make over your life will be paid out in taxes. And so I was like, with that being said, yes, the death tax is Uncle Sam's last ditch effort, created a few decades ago, where it was like, oh, it's just for the very small amount, it's not a big deal. And then, like most things, they spread it out to where it covers more and more of the general population. In the last maybe 10 years, there's been a lot of changes, where I believe the number is closer to 13 million now. You'd have to make over that for you to be eligible. But maybe 10 years ago, 15 years ago, the number was like 600,000, where there's a lot of people paying it. So at least you don't have to think about it as much there. Retired 2019. Hey, my friend, good evening. And it's always good to hang out with you, my friend. Hope you're having a great week. So, when we're talking about high income earners, their household, I believe they were making about 400,000 combined. Let's see if I can remember. Yes, Eric was at 250. Denise was about 200. They were one was like a VP of sales, and then the other one was like I believe he had his own, what was it? I think he was an engineer or something. I can't, it escapes me. It escapes me. It'll come back to me because it's going to be eating away at me. And when it comes back to me, I'll share it with you again. It was an attorney. That's what it was. So we had like a VP of sales and an attorney. So they basically they make about over 400,000 combined. And then when you look at the way they're investing, they are doing a really good job with that. And so we're talking about, hey, how much do I make versus how much I'm investing in myself, right? We always talk about paying yourself first. Is normally a good rule of thumb that if you are saving about 20% of your salary, where whatever you make on Monday, that's what you pay yourself. And then whatever you make on Tuesday through Friday, that can go towards your daily living. That we want to be able to reward ourselves. Now, that may not be where we can start today, but that is the goal I would say we want to work towards. And wherever we're at, we do want to start. I love the idea of just maintaining a lifestyle. So if you were to get a raise this year and it was a 3%, that 3% is then goes towards your investments for your own personal financial freedom. And then that's normally a way that I like to do it, where you maintain your lifestyle and you don't have to cut anything, but you're able to take the increases and add that. And so I do like that one as well. But they were already maxing out their 401ks. They were maxing out their HSA accounts. And you guys know I'm a big fan of the HSA because it has the triple tax benefit. I don't know if it's the only one, but it's literally one of the few options that are available to where you actually don't have to pay taxes on it. So the money goes in tax deductible, so it doesn't count as taxable income today. The money then grows tax deferred, so you don't pay taxes each year that your money is growing, and then the money comes out tax free. And so as long as you spend it on healthcare expenses, which all of us have in retirement, So I'm a big fan of us contributing to the HSA account. And then they have a taxable account. That's just your money that you have like a Robinhood or a Schwab. That's your after tax money. It's in your checking account, and then you put it in your investment account. So that's what your brokerage account ends up being. So they put about $2,000 a month inside of that. As far as their expenses, they're currently about $12,000 a month, and their retirement, I believe they want to go down to $10,000 a month as a plan. And we're looking at retiring at 62. So we had to add what the healthcare expenses would be, where you would go on the Affordable Care Act exchange, right, the Obamacare exchange, and then you would have your healthcare covered through that. Now, they wouldn't qualify for any of the subsidies. They would pay it all out of their own pocket, but they would be able to have that taken care of as well. So that would normally be the next things that we would be looking at and we would think about as we're getting ready for retirement. And so then we go to the goals. Retiring at 62, expenses we want to be down to 10,000. We have the healthcare already covered in there. We use the national average. We have the long-term care covered in there, because if you have long-term care, 7 out of 10 people over 65 and older will have at least one long-term care episode. So the idea for most is they're going to use Medicaid to cover some of those expenses, but Medicaid requires you to drain your assets first. And so if you're a high income earner, then you would either want to put the money aside to cover it, or you want to look at getting long-term care insurance. And that's normally going to be something you look at around 45 to 55. And so they're both 55 right now. So if they wanted to, they could look into getting that and seeing that they qualify. But we didn't think that we would qualify based on the healthcare. So we just put the money aside to cover it. But that is always an option that you have. If you wait until 60, it's not that you can't get it. It's not that you will guaranteed be declined. It's that they normally have like a little bit of a premium attached to it, because the insurance companies know the same numbers. They're like, hey, look, 7 out of 10 people over 65. And if you're 60, then we may not get a premium that many years before you have to dip into it. So they normally add this surcharge onto it. So that's why I normally encourage people, if that's the route you're going, go before 60. Now, with that said, there are Medicaid trusts where you can design a trust in a certain way where you can take your assets, place it in the trust, so it doesn't count as your assets and your income. But for most people, if you're a high income earner, it generally just makes sense to go ahead and allocate some money towards the healthcare expenses. But there are other options available, especially if you feel like you're on the bubble. And we can go into that in kind of another video. But I'm definitely a big fan of trust, and I'll just give you like a quick idea of just kind of the way a trust generally works, just so that way you have that kind of information. But there are literally a ton of ways you can design a trust. And for the most part, it depends on the goals that you're trying to accomplish. And so when you're looking at a trust, normally what ends up happening is there's 3 people. There's the kind of the grantor. So that's the one that has the assets. And then there's normally the trustee. That's normally the person that's going to run the trust. So whatever the rules are for the trust, they are the ones that make sure it happens. So think of it almost like you're like an HOA. So the HOA is essentially where everybody pays the money in. So all of the residents will be the grantors. They are the ones that actually pay the money in. And then you have a board that spends the money. They can't buy themselves a Porsche because there's rules and bylaws on how they can allocate the money. And so they could pay people to mow the grass. They could pay people to paint houses. They could pay people to send evil emails out where it's like, mow your grass and stuff like that. There are things that they're allowed to spend the money on, and there's things that they're not allowed to spend the money on. Your trustee is basically the HOA board. They're the ones that spend the money, but it's based off of the rules that you set in the trust. And then the very last person ends up being the beneficiary. And so they're the ones that get the gift. So what you basically could do is, so if you were to have your trust, what you do is you would say, all right, I'm going to place all my assets in the trust. So if I have a home, for example, instead of my home saying, to Dre Griggs, the home is now going to be at a contract with the bank that's going to be like Griggs Foundation. Like that's just what I named the trust, right? So Griggs Foundation will have my home. And then I can put my cars in there. I can put my business in there. And then I can put some cash if I want in there. I can put stocks in there. I can put anything. Because what you'll do is you'll go to an attorney. So normally what I would do is I would work with your attorney. So I would create the plan, and then the attorney would execute, and they would write the laws, and then it would be approved, and it would exist almost like a business where you'd be like, hey, I'm going to go organize a business. You create the rules and the bylaws, and then at some point in time, you're going to then take that paper and you'll go and open a bank account, and then you put money in the account. Well, that money is the business account. Well, that's the same as the trust. The money is now the trust account. So you'll put all the assets in the trust. The trust and the beneficiary, they'll pay whoever out. So it could be you. You could be the grantor and the beneficiary. So you would get paid some sort of income every single month from the trust, but you don't have any of these assets. The trust does. So then when you go apply for Medicaid, they're gonna be like, oh, look, you don't really have anything. And you're gonna be like, I know, I don't have anything. And they're gonna be like, oh, okay, well, it's all in the trust. The trust does pay you, but it doesn't matter because you don't own any of the assets. And then you would get approved for Medicaid, and you'd be off on your way. And however you design the trust, that is how you would get paid out by the trustee. And then when everything's said and done, you get to decide who gets it afterwards. So your ultimate beneficiary, so you can receive the income, and then after you're done, your ultimate beneficiary could be like your kids. It could be your kids. It could be like your church. It could be really anything. That's your ultimate beneficiary. And then they would receive everything in the trust. You receive the income throughout your whole retirement life, and then you pass on everything to whoever the beneficiary ends up being, right? Like that's the idea. It is one of those things that if you give yourself enough time, sure, you could totally plan it that way. But it is one of those things that if your plan for long-term care is to use Medicaid, because it's based on needs, then you have to have no assets basically. And so they either wait for you to spend all your assets, or you would have to move the assets into a trust, and you'd want to start that a little bit early if that is kind of the plan, because they do have look back years. So for this one, we didn't do that. We simply put the money aside because we had the availability to do that. Their vacations, they felt like that was going to be about $20,000 a year, and so that's what we did. The legacy, we left that blank because we weren't sure exactly how we wanted to divvy out the assets, but we would come back to that. It's like a placeholder. We had the charitable giving. They wanted to be able to give $10,000, and then they wanted to be able to give $5,000 for their children. And they said that was basically to help them pay off college debt. I believe the number is $18,000 for this year that you're allowed to gift to people where it's not like tax. You don't have to record it or anything like that. So the $5,000 they're going to do, there's really nothing to fill out. There's nothing to really think about, no strategies to put in place. You're allowed to do that, and Uncle Sam is not bothered in any way. They did want to get a vacation home. So they were talking about getting a home out in Texas. They said it would be about $500,000. They want to do it at 63. And normally when we're talking about big expenses like that, we're normally going to then cause us to think about IRMAA, because if I have too much income as I'm getting ready for retirement, there's a couple of your Medicare expenses that have monthly premiums. And so your prescription drug benefit, Medicare Part D, and then Medicare Part B also has monthly premiums. And depending on how much your income is, it puts you into a different bracket. Now, based on the income that they had, they were already going to be above the normal minimum brackets, just off their normal income. But we do kind of like to keep an eye on that. So for this particular one, they weren't going to have to increase their income, right? Like it was going to be about $500,000. That's about roughly what they were making. So we did not have the concern about moving them into a higher bracket where it would change their income. But if you are someone that's getting ready for retirement and you're thinking about making a big purchase right before you would take out and apply for Medicare, then it is something that you just want to look at. Because once you get the IRMAA and you get put in a new bracket, that's it. That's your new amount for the rest of your life. You don't get to go lower. So it's definitely something that if we could wait, where we're like, hey, let's wait till 66. If we could, then we should. If it's something that we can't wait, then we can't wait. But know that it does change the monthly premiums as you move into different brackets. And so that was not a concern for this one, but it is something that can be a concern, because a lot of times we are making different decisions as we get closer to that. But this one was fine. All right, so then that was all of their goals. We went over their income and their savings, and then inside of their accounts, right? So Eric had maxing amounts. We had 750 that was in his 401k. Denise had 600 on hers. They both have Roths from when they did a couple Roth conversions. As you're well aware, I think it's 136 is the income limit for a Roth as an individual, and it's like like 240 or something like maybe like 210, somewhere around there for a couple. And so they make over that. So they would not be allowed to just go through the front door and place the money into a Roth account, but they can go through the back door. Uncle Sam had passed a law in, I think, 2009. He was trying to get more tax revenue. And so he changed it to where people were allowed to do a backdoor Roth. I have the money inside of my 401k and my other pre-tax retirement accounts, and I'm allowed to move it from my 401k into a Roth, and I just pay the taxes that year. And then boom, I have the tax-free money. So I can go through the back door. And so we were able to, basically we started that. And I'm going to show you how we're going to do it each year. And you normally would either do it based on your tax bracket. So the idea is, well, if I always pay 22% in taxes, and then I have any years leading into my retirement before 73 and I have required minimum distributions normally, if I have any moment that I'm able to find myself with a lower taxes than my normal 22, then I can go ahead and just take out a Roth conversion. I claim that as income. I pay my normal taxes, but now I have more tax-free money in my retirement account, which is obviously very nice. And I'll show you how that can help you. So that's kind of what we're starting with them there. And then they have their joint brokerage account, which is 250, and then their HSA has 25,000 that's set aside. So when we started putting the plan together, as I mentioned, when you're already contributing the amount that it would probably get you, the main thing that we focused on, and so you can see the 66% was largely because of the 500,000 purchase of the vacation home. That was where it was like, like Dre, we completely understand if we're unable to get the vacation home, just kind of tell us, and then we're like, no, we can put a plan together where you'll be able to still get the vacation home. Just give me a couple days. And so normally, as we say, the goal is to get over 70% for the probability of success. It's a Monte Carlo simulation, so it runs 1,000 scenarios. And unlike Thanos in the Infinity Wars, it wasn't like there's only one way, or Endgame, I guess is right. Doctor Strange was like there's one way. It wasn't. There's not one way. We're saying that out of 1,000 scenarios, 800 of them work out for you. And we're saying of the other 200, and there's like crazy stuff going on where we're talking about the Social Security drops by 20%, stock market also drops by 20%, and they raise taxes by like 5%, like all three of those happening. And so normally we're like being prepared, but recognizing that, like that's very unlikely. So we're around 80%, so we feel really good. We're over that 70. And the only change that we made is we focus really on the tax strategy. So you see, we didn't change anything else. You want to retire at 62, cool. The amount that you're contributing to your accounts, that's fine as well. The retirement lifestyle that you believe you'll have, that's a-okay too. And we left the vacation home in there at 63, that's fine too. The only thing that we changed is their taxes, and that took them from under 70, where it was like, oh, I don't know, to where we were to get them closer to 80%, where it's like, hey, that feels really good. So let's go through, and I'll share with you how we ended up doing their conversions, because I basically already had hinted at that for you. And so I'll share that with you. I feel like it is loading really slow today. Maybe it is. All right. There we go. Okay, so what we ended up doing is the allocation, we focused on the tax-free account. So we're going to put the money going forward where if we are torn between putting the money in our 401k or putting the money in a tax-free account, we're going to put money in the tax-free account. Sometimes that means that we'll lower the percentage, because once the money's in there, we don't necessarily need to move the money around in those accounts. Normally what we do is we change the percentages going forward, and then we'll do the Roth conversion, so that way we can move it over while still getting the match, because I think their match was 5%, but they were putting in more than that. And so we said, let's focus on the tax-free accounts. Then we'll do the taxable accounts, because that will be taxed as capital gains in retirement, which is a lower tax rate, versus it being taxed as ordinary income because it's in your pre-tax accounts. And so then the deferred taxes was the last one. And then when we're talking about our withdrawal sequence, we will take out the taxable first, and then the tax deferred, and then the tax-free would be last. As far as the Roth conversions, what we decided to do is anytime you found yourself paying less than your normal 35% in taxes, we did a Roth conversion. And as long as you do something like that, we just maintain what their normal taxes were, so it didn't impact their normal lifestyle. We're just operating in a more efficient manner. you can see that it ended up creating another $3.6 million more in their tax adjusted ending balances. So they're able to have more money in their tax-free accounts and just more money in their accounts in general because they didn't have to take as much out. And then we're able to save almost $1 million in taxes over the life of their retirement. And then we were able to get close to 5.2 million less withdrawals from your tax deferred accounts. And the reason that that works is a couple of things. One is I don't have to pay taxes on it. So because I don't pay taxes on it, when I live off of $100,000 a year in my tax-free account, I actually can take out $100,000 a year. If I live off $100,000 a year and it's in a tax account, that means that I need to take out whatever my taxes normally are. So if my taxes is normally whatever 20%, then I would need to have an extra 20,000 I take out, so that way I can place that for my taxes, and then I have the net of my 100,000. So because the money was now in a tax-free account, we don't have to take out the 120,000. We just take out the 100,000, right? So that is where you get that. That's one. Two is if the amount is in a tax deferred account, like your 401k, your 403b, your TSA account, what ends up happening is you eventually run into required minimum distributions. And that amount gets larger and larger the older and older that we get, to where we either have a 25% penalty or we have to take out a certain amount of money every single year because Uncle Sam's been waiting for the tax revenue and he says, I'm not waiting anymore. And so when you don't have required minimum distributions, as is the case with your Roth accounts, that then also means I don't have to take money out if I don't want to or need to spend it. And so they had those two things going for them. That's why they had an additional 5 million in their account. It's not that they didn't have enough money to be able to make it throughout their retirement. The issue was they had to take out so much, and then they weren't necessarily going to be able to reallocate it in a way that was the most efficient way for them. So you can see that what we ended up doing is it ended up creating a few million more dollars in their account just by optimizing their taxes. Everything else was already going good, and they were very close to being able to maintain and get their retirement home. But what might have happened is if you were someone that, let's say you already had a tax-free account, so you're on the bubble, then maybe instead of paying it all off, what you would do is you get like a 10-year mortgage. So you would pay off maybe you pay off like half of it, maybe pay off 3/4 of it, 75% of it, and then you would just get a 10-year mortgage on the last amount. And then what that would do is that will then give you the spread for your money to continue growing because you don't have to take it all out. And then your growth in your account is probably going to be more than what that monthly payment is. And so now you're using your money to pay off the debt. Instead of you working, your money is still working for you. And so that would have probably been the second thing that we would have looked at. And so I can show that to you real quick. So what we would normally do is we would go to the vacation home. I'll show it to you, and we could just see what that would have done for them. And so when you go to the goals, we're talking about our vacation home. And so basically what we would have done is we would have said, I'm going to do a down payment of 50%. I'm going to give myself a 10-year term. And oftentimes what I like to do, what I prefer to do, as long as you're disciplined in the way you pay your bills, ideally what we would do is we would get a 20-year, 30-year term. So that way you have the lowest possible monthly payment, and then you just pay it as a 10-year. Because a couple things ends up happening for you, and I can show that to you real quickly on the whiteboard. And so what ends up happening for you is, all right, boom. All right, let's switch over, perfect. All right, because what ends up happening, let's say you would have had, let's say if you had a 10-year, I don't know what that was, so let me get rid of that. All right, so let's say you would have had a 10-year, and that might have given you a payment, just to make math easy for me, $1,000 a month. If you had a, let's say 20-year, maybe it would have been $500 a month. What we would have liked to do is, if you're disciplined enough, we would just pay the $1,000 a month over here. And then what ends up happening is kind of cool. So what you end up doing is you end up with this amount that ends up being principal and interest, right? Because that's how your payment is calculated. And then the other 500, the extra, would have just been principal, right? Because I'm paying more than the minimum payment. And so what ends up happening is over here, if you set it up as a 10-year, this would be principal and interest, right? Because that's how it's set up. So this entire amount is principal and interest. On this one, it's just this amount is principal and interest, and this amount is all principal. So as long as you're able to maintain the discipline of paying the $1,000 a month, you are able to pay it off much quicker because your money is working more efficiently. Now, if something happens, so let's say you call me up and you're like, Dre, there's a cruise. I gotta go. I'm like, hey, no problem. For the next 2 months, just pay the $500. And then after that, you can go back to paying your normal $1,000 because you locked in a lower monthly payment. You're not required to pay the $1,000. If you want to take off a month or 2 or 3 or 6, you can. No harm, no foul. Just your normal payment, and then you can go back to paying the extra amounts after that. Now, that is something that I like to do as long as you are comfortable and confident that you're able to maintain that. Now, if you're someone that's like, look, Dre, I don't know, man, if the money hits my account, I don't know anymore, then, you know, we can set it up with the 10-year, or we can leave it as the 20 and you just pay it off in 20. That is the options that you have, right? You get that choice, whatever makes the most sense for you. Hopefully that makes sense. So then we'll go back to so we'll get a 20-year term. I think the interest rates are probably going to be somewhere around like 4.5. Well, yeah, something like that. It's a vacation home. It's probably a little bit more risk, so we'll just say it's a 6%. All right, and so let's see what that ends up doing for their plan. It's bubbling. Okay. I think I have to go back and update it. Let me see. So down payment is 50%, term is 19 years, we're paying it 6% interest, and it was in Texas, like we mentioned, start at 63. Yeah, so it's saying that actually roughly keeps them roughly about the same. So that one, you could have done either option, whichever one is most comfortable for you. And for a lot of people in retirement, they like the idea of not having bills, and so they wouldn't have to worry about that. So that one ended up being about the same. So then that would be the option for you, whichever one makes the most sense for you. All right, and so you can see that whatever the options are, we always have 3 levers, right? I can retire later, I can spend less, or I can save more. And for this one, we didn't need to save more, we didn't need to spend less, but we technically spent less by lowering our taxes. So sometimes we spend less by not going out to eat for dinner, or maybe having a less extravagant vacation. Sometimes we spend less by just optimizing our taxes, and then we don't have to worry about giving Uncle Sam extra money. And so that's what we're able to do for this one. And that is it, ladies and gentlemen. Hopefully you found value in that video. I always appreciate the time that we have together. And if you don't have any additional questions, we'll do this again next Thursday. And as always, I'm thankful. And until next time, stay safe and enjoy life.